Hello and welcome to today's video. After covering protocol Solstice on my channel, which represents institutional parts introduced to the DeFi, today I will be covering another interesting protocol named Hylo, also on Solana, and what makes it special is its specific approach to issuing stablecoins and at the same time offering leverage exposure to Solana. And when you combine this with current points system ongoing, you have combination for exciting period for this protocol ahead. Before diving in, disclaimer. Before we start, disclaimer, nothing here is a financial advice. I'm just one person with a microphone. Always do your own research. First, what problem do they try to solve? It is related to the stablecoins, but to get an idea, we need to look first at the existing ones. Starting with the most proven examples such as USDC and USDT, these coins successfully maintain price stability and capital efficiency, but they fall short when it comes to decentralization, as they depend on centralized banking system and traditional finance infrastructure. On the other side, decentralized stablecoins address the issue of control but introduce new inefficiencies. For example, MakersDAO DAI achieve stability throughout collateralization, which limits scalability and efficient use of the capital. Then there are algorithmic stablecoins such as UST by Terra Labs, where the peg was maintained throughout a mint and burn mechanism tied to Luna. This model ultimately failed during periods of market stress. Finally, synthetic delta neutral stablecoins like Ethena USDE rely on hedging mechanisms that involve centralized exchanges. While this design brings stability and efficiency, it weakens decentralization, and the risk of such dependency became visible during the recent waves of forced liquidations across major crypto platforms. In this environment, Hylo introduced Hylo USD, which aims to solve the stablecoin trilemma by achieving price stability, capital efficiency, and true decentralization, at the same time by introducing their mechanics and risk management, about which I will talk in more detail today. So Hylo is a DeFi protocol built on Solana that introduces a new approach to both the stablecoin market and leverage exposure to Solana. It operates throughout a dual system. The first component is Hylo USD, a decentralized stablecoin backed by Solana liquid staking tokens such as xSOL. The second component is xSOL, a token that provides leverage exposure to SOL's price movements. Now we can already address the first risk present, the one related to the liquid staking tokens. When Solana is used directly, the main concern is simply price volatility. However, with liquid staking tokens such as xSOL, for example, two additional layers of risk appear. First, there is a peg risk, meaning the value of a liquid staking token can temporarily deviate from the price of SOL during periods of high market stress or low liquidity. The Hylo team has taken steps to prevent issues like those seen during the October 10th crypto liquidation event, the largest in its history, when Binance oracles malfunctioned. Instead of relying on centralized price oracles, Hylo determines that via the protocol Sanctum, which provides precise data on the amount of the staked Solana backing each liquid staking token. This approach ensures accurate pricing, greater transparency, and stronger protection against similar oracle failures in the future. Second, there is a smart contract risk, since these tokens rely on staking protocols and validators that could face technical failures, bugs, or even security issues. Now onto its dual token system. So Hylo USD and xSOL are backed by a diverse basket of liquid staking tokens called the Collateral pool. At any point in time, the sum of the two tokens' market capitalizations is equivalent to the total dollar value locked in the pool. Now onto pricing. The Hylo USD token is a stablecoin, meaning its price is always fixed at $1. The xSOL token, on the other hand, represents the variable reserve, the portion of collateral that isn't directly backing Hylo USD. Its value changes based on how much excess collateral exists in the pool. Let's break it down with an example. So imagine there's $100 worth of Solana in the reserve. Half of it backs Hylo USD, ensuring that every Hylo USD is worth exactly $1. The other half backs xSOL. Now, if the price of Solana doubles to $200, Hylo USD remains stable at $50, while xSOL captures the upside, becoming worth $150. In other words, the price of xSOL triples. If the price of Solana would drop to $75, Hylo USD still holds its $50 value, but xSOL falls to $25. These examples show how xSOL acts as a buffer, absorbing the volatility of Solana, protecting the stability of Hylo USD. The price of xSOL continuously adjusts to ensure the total reserve value always equals the combined value of both Hylo USD and xSOL. As we know by now, xSOL provides leverage exposure to Solana. This leverage comes from the relationship between the total value locked in the system and the amount of xSOL in circulation. By dividing the total collateral value by the value backing xSOL, we can estimate the current leverage ratio. For example, imagine there is a $100 worth of Solana in the reserve, $50 is used to back hyUSD and the remaining $50 to back xSOL. Since the total collateral is $100 and xSOL represents half of that, its effective leverage is 2x. This ratio is not fixed. It changes dynamically as new hyUSD or xSOL tokens are minted or redeemed. In other words, xSOL leverage adjusts in real time with every movement of collateral within the system. That is why xSOL behaves like a built-in leverage version of SOL, amplifying both gains and losses. One important characteristic to mention for xSOL is volatility decay. While xSOL offers a simple and efficient way to gain leverage exposure to Solana, it is important to understand the risk of volatility decay. Volatility decay refers to the tendency for leverage tokens to lose value over time in volatile markets, even if Solana price returns to its original level, something similar to leverage ETF of Tesla. This occurs because xSOL's value is path dependent. Large price swings both up and down can erode value due to the way leverage amplifies gains and losses. xSOL is best suited for users with strong directional view on SOL and understanding of the risk associated with holding leverage tokens over time. hyUSD holders can earn outsized yields while securing the Hylo ecosystem throughout the stability pool. This key earning feature offers users high rewards in exchange for specific risk. More on that in risk management part. When you supply hyUSD, you can earn an attractive annual percentage yield, currently around 14%. In return, you receive a yield-bearing version of hyUSD that serves as a proof of your deposit. This token can also be used across other protocols to generate additional returns. Your yield compounds over time and the accumulated rewards are distributed at the end of each epoch automatically in the stability pool. Staked hyUSD holders collect rewards from the entirety of Hylo total value locked because xSOL and unstaked hyUSD holders do not benefit from the yield on their respective collateral by design. As such, the yields generated by the protocol are shared only among those who stake hyUSD. The easiest way to understand this concept is throughout an example. So, imagine that the Hylo protocol holds 10 million in Solana reserves throughout liquid staking tokens. By design, this amount is split evenly, with 5 million converted into hyUSD and the remaining kept as xSOL. When you stake or supply hyUSD, you earn a yield in the form of annual percentage yield, while xSOL does not generate yield because it represents leverage exposure to the underlying Solana price. In other words, each side offers a different trade-off. hyUSD provides yield stability, while xSOL offers potential price upside. Now let's assume that 40% of the total hyUSD supply, or 2 million, is staked. The protocol earns around 8% annually on the entire $10 million in liquid staking tokens value, which equals about $800K per year. This total yield is distributed among the stakers. Since only 2 million hyUSD is staked, dividing $800K by that amount results in an effective API of roughly 40%, much higher than the base 8% generated by liquid staking tokens. Of course, this is an ideal example. In reality, factors such as SOL price fluctuations, market volatility, and user behavior all influence the actual return. Still, this example helps illustrate the core logic. The protocol makes staking hyUSD attractive for users, and those users in turn help strengthen the overall stability of the system. That dynamic is what I will explore in more detail next. Following this logic, the size of the annual percentage yield depends on how many users decide to stake their hyUSD. As this graph shows, the higher the percentage of stakers, the larger the distribution pool becomes, which reduces the API for each participant. Conversely, when fewer users stake, rewards are shared among a smaller group, resulting in higher API. Now on to risk management. So Hylo implements a multi-tier risk management approach centered around one key metric, the system collateral ratio. The CR is a measure of system health, indicating the ready availability of the backing assets behind hyUSD. The system requires a CR over 100% to stably back every dollar worth of hyUSD. When CR is over 150%, the system is considered fully healthy. If the CR falls to 100%, the net asset value of xSOL becomes zero and hyUSD loses its hedge, exposing its peg to the full volatility of Solana. There are two stability mechanisms to keep CR as high as possible: mint redeem controls and the stability pool. The protocol automatically initiates corrective measure once a specific stability mode is triggered. In the case of Hylo, there are two such modes. The first is activated when the collateral ratio falls below 150%, while the second comes into effect effect once it drops under 130%. The rationale behind these specific thresholds is detailed in the value at risk analysis, which can be found in documentation. When the collateral ratio drops below 150%, the protocol adjusts minting and redemption fees. Fee controls financially incentivize users to perform actions which increase the CR while discouraging actions which decrease it. When the collateral ratio crosses the second stability threshold at 130%, more drastic measures are taken. Fees to control token supplies are more aggressively adjusted and the stability pool is activated. The stability pool provides users the opportunity to earn attractive yields as described before, but in return, when we get CR ratio below 130%, staked Hylo USD in the stability pool is drawn down and converted to xSOL. The positive effect of burning Hylo USD and minting xSOL quickly recovers the CR to a healthy level. Stability pool users acknowledge this potential swap as a risk in exchange for financial rewards during normal operation. When users wish to withdraw from the pool during market turbulence, a pro rata share of the minted xSOL is returned to them. Now let's look at another example to make this easier to understand. Imagine that the system holds 100 SOL in total. At a critical moment, 80 SOL is backing Hylo USD while 20 SOL is backing xSOL. Here it is important to recall the concept of the buffer that we previously associated with xSOL. This buffer means that a relatively small amount of xSOL can protect a much larger amount of Hylo USD because xSOL functions as a leverage token. In this situation, with 80 SOL backing Hylo USD, we calculate the collateral ratio as 100 SOL divided by 80 SOL, which gives us current collateral ratio of 125%. This value is below the critical threshold, meaning the system is entering a risk zone. At this point, the stability pool comes into play. Suppose 10 SOL worth of Hylo USD is converted into xSOL, the balance now shifts, with 70 SOL backing Hylo USD and 30 SOL backing xSOL. This adjustment restores the collateral ratio to approximately 142.5%, bringing its system back to the safer range. This example shows how the stability pool dynamically adjusts to maintain healthy collateralization and protect overall system stability. There are also additional steps for extreme cases like mint and redeem bounty, where there are bonuses to users who mint xSOL and redeem Hylo USD, and recapitalization in most extreme cases where insufficient Hylo USD is available to stabilize the protocol, where accumulated treasury funds are used to recapitalize the protocol. Here you have stress test simulation. How would protocol perform if Solana price were to fall as much as 50%? This is also available on their website. This protocol stands out not only because of its innovative approach to stablecoins, but also because it has introduced a point system for early users, which often leads to future airdrops. Here is where the idea behind xSOL becomes especially attractive. Normally, if you simply hold Solana in your wallet, you only benefit from price movements. But with the Hylo protocol, you can deposit your Solana, where half of it is used to mint Hylo USD as stablecoin, while the other half becomes xSOL, which keeps exposure to Solana price. In practice, this means that with the same amount of SOL, you can do much more. You can farm points for potential airdrops, earn yield, and still participate in prices of Solana all at once, instead of just holding it passively in your wallet. You start earning points by using one of their products available on the platform. The multipliers applied to each product are shown in the image. The dashboard is quite exciting. As you collect points, you gradually unlock new levels, which adds a sense of progression and gamification to experience. You can also earn crowns, a special type of reward whose purpose has not yet been revealed. Now that you know the available products, you can choose the one that fits your strategy by simply holding the tokens in your wallet. You will start earning XP points automatically. Next, I will share my own approach, which is probably on the riskier side, but my goal is to farm as many points as possible. I decided to go directly with xSOL. Keep in mind that it offers the highest multiplier among all products, which usually means it carries the highest level of risk. I will explain more about that later when I discuss potential downsides. As shown in the image, I purchased 95 xSOL for 110 USDC. The price will vary depending on when you make your purchase. To keep things simple, imagine you buy 100 xSOL with a 20x multiplier. That would earn you 2000 points per day. In my view, buying xSOL at current levels is attractive because it recently experienced a pullback and is trading near the lower end of the Bollinger Bands. This setup allows me to benefit from potential upside in price while also earning points at the same time. The next part of my strategy involves using the Exponent protocol, which currently offers an exceptionally high number of points for every dollar invested. In my case, 100 xSOL is earning me around 100 24k points per day. However, there is a catch. To earn these rewards, you need to lock your xSOL position, which gives you farming rights but also means you will lose your entire principal at maturity. For this contract, the expiration date is November 26. In other words, I'm sacrificing 100 xSOL, which is about $122 at the time of making this video, in exchange for potentially massive point rewards. This approach carries a higher level of risk since there is still no confirmed airdrop or token, even though I personally expect one in the future. It is a classic high risk, high reward move, but when you are starting small, sometimes that is exactly the kind of opportunity worth taking. Here it is, my full strategy. I also heard, although I need to still test it myself, that exponent positions tend to lose most of their value in the final 10 days before expiration. It might be worth closing the position earlier once it gets close to that period. This is something that definitely needs active monitoring. Lastly, about dangers of this kind of protocol, so the most obvious one is smart contract risk, which exists in every DeFi project if a bug or exploit is discovered. Another important factor is xSOL volatility decay, discussed before in more detail. Finally, the biggest overall risk is the price of Solana itself. A severe bear market with sharp drawdowns would likely put pressure on the protocol in the short term. However, if you believe in Solana long-term strength, the protocol should be able to recover over time thanks to its built-in risk management mechanisms discussed earlier. Okay, this is everything for today's video. Hope you like it. If you want my full written deep dive, you can check my Substack. Also, for more market updates and daily insights, subscribe to my X account, and you can check my website for other educational content. So this is it. Hope you like this video. Like and subscribe as a sign of support, and see you in the next video. Bye.